Hey everyone, George here. So if you're a construction business owner, a project manager, a superintendent, somebody making decent money, this video is very important, even if you think retirement rules don't apply to you yet. The IRS just finalized some rules tied to Secure 2.0. And on the surface, they may sound boring, but are two changes that could directly impact your cash flow, tax strategy, and retirement planning for 2026. And the worst part, a lot of contractors won't even find out until they've already made the wrong move. So in the next few minutes in this video, I'm going to break down in plain English specifically for construction business owners what all this entails. No IRS jargon, no theory. So without further ado, let's get started. So who does this video apply to? If you're a construction company owner, a contractor running multiple entities, a highly paid project manager, superintendent, or executive, anyone earning over $145,000, anyone relying on 401k catch-up contributions, and anyone who actually cares about the timing of refunds and cash flows, this video is for you, so keep watching. So Secure 2.0 was passed a couple of years ago to quote-unquote modernize retirement rules. So it sounds pretty harmless on surface. And like most tax laws, the headlines made it sound generous. But the fine print quietly took away flexibility from high earners. So the IRS just issued final regulations, meaning these rules are now locked in. And contractors are disproportionately affected because usually their income is too high. Pay can come from multiple entities, and planning is usually done later in the year because of cash flows. Because at the end of the day, construction businesses are cash flow intensive businesses. So let's get into the changes. What's the first change? Number one, catch-up contributions are now mandatorily Roth for high earners. So the old rule was that if you're over 50, you could make catch-up contributions to your 401k, and you could choose to make those contributions either pre-tax or Roth. So pre-tax, obviously, you get a deduction for what you contribute, and you defer the tax, you pay it later on. And Roth, you don't get any deduction today, but it grows tax-free. So in my experience, most contractors choose pre-tax, especially in high-income years. So the new rule, starting in 2026, if you earn more than $145,000 in the prior year, all catch-up contributions must be Roth. So let's make this into a real example. Say you're 52 years old, you run your construction business. You had a pretty strong year and you're planning to put away an extra $7,500 into your 401k. Before, with the old rules, that $7,500 reduced your taxable income, but now, unfortunately, that does nothing to your tax. Same contribution, very different outcome. So what's the next big change? So if there are multiple entities that you work for, whether your own or another employer, the IRS is now adding all your wages up together. This part is actually huge for construction businesses because under the old law, there was a gray area. If you worked for multiple companies, multiple entities, even different ones that you owned or, had one or several W-2 jobs, you could do 401k contributions to each, and operating in the gray, each would have its own contribution limits. But under the new rule, the IRS has plan administrators aggregating your wages against all your income sources. So if you have multiple construction companies, if you use management companies, if you run separate entities for labor, equipment, or real estate, or are part of any joint venture, and if you're thinking like, oh, okay, each one paid me under $145,000, I should be fine. Unfortunately, under the new law, the IRS says, nope, we're adding it all up. And you can unexpectedly fall into the Roth mandatory catch-up bucket. And most people won't realize this until it's already too late. Next big change, the super catch-up for people ages 60 to 60. So there is now this $11,250 super catch-up if you're in the ages of 60 to 63. So that got finalized, but unfortunately that as well, it falls into the mandatory Roth bucket, assuming that you're over the income. So yes, you could put more in if you're 60 to 63, but unfortunately it's not tax deductible now. And final change with the finalization of these Secure 2.0 laws is that paper refund checks are going away. So originally the IRS came out and said they'd stop issuing paper refund checks starting September 30th, 2025. Now they've actually come out and clarified that this won't affect tax years before 2025. But starting with the 2025 tax returns, they are strongly pushing direct deposit. So if you don't include bank information, routing, and account numbers, your refund could be delayed 6 weeks or more. So if you're a contractor who's relying on a quick refund, if you're filing late, filing amended returns, filing an extension, filing later, I would highly urge you to put in routing and account numbers, not rely on paper checks. Otherwise, you're going to have a 6 to 8 week delay. So what should contractors do now? Number one, stop assuming that catch-up contributions lower taxes. That assumption is now wrong for many high earners. Number 2, review your entity structure. So having multiple entities increases your chances of becoming Roth. Number 3, plan earlier in the year. So planning in December, you might be in for a surprise. So I always tell this to my clients. So the sooner in the year you could start doing your tax planning, the more strategies and the more options we have. The later we wait in the year, that window closes up. So, and once the year is over, there's very little you can do. There's tax strategy. So early tax planning is key, especially if you're expecting to have a good year, you want to get ahead of the game. Number 4, add direct deposit information to your return. I wouldn't rely on paper checks from the IRS anymore, and especially if you don't receive it, calling the IRS, getting a hold of somebody, half the time they just give you the runaround. It becomes a serious ordeal. You just don't want to deal with it. And coordinate your CPA and retirement plan provider. A lot of these problems happen when these two don't talk. So if any of this applies to you, our calendar link is down in the show notes. Feel free to book a time. Hope you found this helpful, and see you in the next one.